Ladies and gentlemen, good day and welcome to Q3 and 9 months FY22 earnings conference call of Nuvoco Vistas Corporation Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Desa from CDR India. Thank you, and over to you, sir.
Thank you, Aman. Good day, everyone, and thank you for joining us on Nuvoco Vistas Corporation Limited's Q3 and 9 month FY22 earnings conference call. We have with us today Ms. Madhumita Basu, the Chief of Strategy and Marketing, who will represent the company on this call. Before we begin, I would like to point out that some statements made or discussed on the call may be forward-looking in nature and must be viewed in conjunction with the risks the company faces. The company does not undertake to update them. A statement in this regard is available for reference in the presentation shared with you earlier. We will now begin the call with some opening remarks from Ms. Basu, who will share perspective on the business model and strategy of the company, post which we will have the forum open for an interactive Q&A session. I now invite Ms. Madhumita Basu to share her views. Over to you.
Thank you, Gavin. Good afternoon, ladies and gentlemen, and welcome to the Q3 earnings call of Nuvoco Vistas. I sincerely hope that you and your family are safe and healthy. Since this is the first time we are meeting in the new year, I also take the opportunity to wish you and your families all the best for the year 2022. Let me start with the overall cement industry situation in the country. As you all know, this quarter witnessed a double whammy, where on the one side the industry was impacted by weak demand, while on the other hand, increase in fuel prices squeezed the industry margins. Cement demand during quarter 3 is estimated to have shrunk by 4% on a YOY basis, but the highest brunt was felt in East India, where we have the major part of our operating territory. Cement demand in East estimated to have declined by 16% on YOY basis. We faced a slew of unthinkable challenges. First, there was the transportation strike in Chhattisgarh, followed by a delayed withdrawal of monsoon and flood conditions in Bengal and Orissa. Finally, we faced a sand mining issue in Bihar, which got resolved only as we went into the first couple of weeks in the month of December. It was only in late December that we started witnessing a pickup in cement demand. As we entered the month of October on the pricing front, we saw a visible improvement in sentiment and undertook price hikes in October. However, with the depressed demand conditions continuing, these price increases we saw rolling back towards the end of November and early December. Due to the late recovery in demand in the Q3 quarter, we did not get an opportunity to reinstate further price increases. Overall, during Q3 FY22, there was an estimated 6% YOY increase on a pan-India basis. Price increases in North and East were slightly muted at 3% and 4% respectively. Taking a look at the Q4 outlook, currently we are witnessing good traction in the market in the seasonally strong quarter and given the pent-up demand of Q2 and Q3. We believe overall Q4 should witness strong demand recovery compared to last quarter, and with the potential clinker shortage, there will be an opportunity to take price corrections. We could take price hike of about 30 to 50 rupees per bag across markets in East in the month of January. Further, in February 20, there has been an increase of 20 rupees, which is currently under stabilization. In North, which has witnessed a more stable pricing condition, prices have gone up by 10 rupees per bag in the month of January. On a more medium-term basis, we are looking positively at the industry. The union budget has set a very positive tone. The 35% increase in capex for FY23 is heartening and will provide the necessary thrust for a much-needed infrastructure growth in India. Government's continuous focus on schemes like PM Gati Shakti, the necessary impetus to national highways, Gramin Sadak Yojana, metro rail projects, and Awas Yojana augur well for the industry demand in the coming quarters. On the cost front, as you all know, the increase in fuel prices have hit the industry hard in the last couple of quarters. Average coal price has doubled and petcoke witnessed a 118% YOY increase. While coal supply is now improving, we do not see much of a let-up in the cost units in the coming couple of quarters. Secondly, the high diesel prices and transporter strike in Chhattisgarh led to an upside on freight costs. Moving on to our key focus areas and our internal levers, I would like to recap that we were looking at an EBITDA improvement of 250 INR per ton by FY23. I would like to mention that despite heavy macro headwinds, we constantly worked on the levers which were under our control and continued to derive value from them. In the 9-month period of FY22, we achieved an incremental EBITDA of 167 rupees per ton on YOY basis, which is already ahead of our rupees 150 target for the year. Just to recap, under internal focus areas, we are working on 5 main levers. One is CPP and WHR related power fuel cost reduction. Second, price acceleration program. Third, reduction in fixed costs. Fourth, project sprint. And fifth, incentives. Just to elaborate on our flagship project sprint, which is focused on building synergies between Nuvoco Vistas and New Vista operations, we have projects under various buckets like clinker rerouting, procurement strategies, introducing Concreto and PCC, and adopting the best practices for both companies. I would like to take a pause at this moment and share with you our growth plans. I hope this will bring cheer to all of you. We have been regularly engaging with our investors and analyst community and have received pushback to revisit our Northern Region plan. It gives me pleasure to share with you our capex program. We are in the process of augmenting our cement volume availability by approximately 2.4 million tons per annum. To achieve this, we are already on track on the ongoing debottlenecking in Rishta and Nimbol. In addition to this, we are upgrading our blending unit at Bhiwani, Haryana to a grinding unit. We see the Haryana government incentive program valid through till 2026 as a strong reason to strengthen our base in Haryana. Also, with the introduction of our Double Bull brand successfully in the market of North and our existing channels and our dual brand strategy, we are very positive about the opportunity to grow in the northern markets. The debottlenecking and upgradation projects will collectively involve a capex of 400 crores. Demonstrating our commitment towards sustainability and reduction in carbon footprint, we are also setting up alternate fuel material handling facilities at Rishta and Nimbol cement plant at an approximate capex of 50 crores. Thirdly, an update on the Gulbarga expansion. We will be putting up a 6,000 TPD clinker capacity in phase 1 of the project with architecture for higher capacity upgrade. Gulbarga plant will help us to cater to the Maharashtra market. We already have operational limestone mine to serve the requirement of this facility. The groundbreaking for expansion project is set for FY23 with an approximate capex of 1,500 crores. I will now move on to give you an overview of our RMC and MDM business. I'm happy to announce that both businesses are regaining growth. RMC business has witnessed a healthy volume growth of 34% on YOY basis during Q3. We now have 54 operational plants pan-India. We have set up new plants in the last quarter, Numaligarh in Assam, Miapur in Telangana, and Vapi in Gujarat. I am happy to share that we are actively contributing to India's growth by becoming a part of the upcoming high-speed railway project. Revenues from MVM business have also shown a healthy growth at 36% on YOY basis. Moving on to an overview of the financial performance of the company. In Q3 FY22, despite severe headwinds, we were able to improve our trade ratio to 75%, while premium product share stood at 32%. While the Q3 FY22 saw a decline in volumes YOY by 13%, on a 9-month basis, cement sales volume improved by 6%. We continue to remain focused on our price acceleration program. High trade share and premiumization enable us to beat the price fluctuations in the market. When the market prices in North and East estimated at a 3 to 4% increase in Q3 compared to last year, our blended NODT per ton increased by about 8% YOY. Our revenues for the first 9 months of FY22 improved by 17% YOY to 6,388 crores on the back of higher volumes and increased NODT per ton. On the cost front, I stated earlier that the industry was severely impacted by power and fuel costs. Our power and fuel costs rose up to 1,285 per ton, increasing by 50% on YOY basis, primarily due to inflated coal and petcoke prices, which went up by a factor of 2, and lower availability of linkage coal in Q3. As you all are aware, we have a unique advantage of up to 30% linkage coal in eastern part of the country, against which we were able to source only 12% of linkage coal in Q3. The positive news is our linkage coal has resumed since late December 21, which will help moderating our power and fuel costs in the coming quarter. We shall also be focused on driving our WHR and CPP capacities, which were muted in Q3. The freight costs were impacted primarily with high diesel prices, increase in freight, and rake shortage impacting our clinker movement. Our distribution costs did see an impact of 11% YOY to rupees 1,371 per ton. Our consolidated EBITDA for the quarter stood at 242 crores. Despite being a difficult macro situation in the last couple of quarters and continuous headwinds from inflated costs and weak demand, our EBITDA for the first 9 months improved by 3% YOY to rupees 1102 crores. We remain committed to prioritizing deleveraging while looking at a steady growth. Our net debt has fallen by 1,235 crores in the 9-month period to rupees 5495 crores. We are also working towards improving our cost of capital. I'm happy to state that our average cost of borrowing has substantially reduced by 165 BPS from December 20 to a current running rate of 6.68% in January. We have recently refinanced loans of about rupees 850 crores at a substantially lower interest rate than this. Our continuous efforts towards this will provide us a benefit in the subsequent quarters. With regard to IPO proceeds deployment, we have over 700 crores of proceeds, which is intended for debt repayment. These loans will be maturing in March and will be paid as such. Sustainability, coming to the sustainability project, which continues to be a key agenda of the company. We expect to get the external validation completed on our carbon footprint baseline in the current quarter, Q4 FY22. and a detailed roadmap to reduce carbon emissions is in the process. I would, however, like to reiterate, we are on an accelerated pace on all key levers for carbon footprint reduction. Firstly, all of our kilns are equipped with WHR, and we are one of the best in the industry with around 2:1 power to cement ratio. We have given good thrust to the alternate fuel projects, and I have already mentioned to you our investment plans in this regard. This quarter, we witnessed a further improvement in AFR from 4% to 6%. I'm happy to mention that our Chittor cement plant has achieved 20% alternate fuel rate during this quarter. On the green footprint, our PCC volumes have increased 8 times on QOQ basis. This has enabled us to improve our C/K ratio to 1.8x. With this, I would just like to summarize that we remain focused on factors which are under our control despite the heavy macro headwinds that the industry has been facing. We remain committed to our premiumization program. We continue to improve our trade share. We were able to deliver a target of 167 INR per ton incremental EBITDA, beating our internal levers budgeted program. Our alternate fuel rate improved to 6%, with Chittor cement plant achieving 20% AFR. Net debt declined by 1,235 crores since March 21. A substantial reduction in our cost of borrowings with refinancing of loans. While the benefit of these initiatives is getting offset by some of the cost increases, with the improvement in demand in Q4, we remain bullish on the performance. Further, in line with our expectations, we have announced expansion projects primarily targeting northern and western markets. We are continuing to invest in sustainability programs and committed to reducing our carbon footprint. With this, I would like to end the contents from my part and open the floor for questions. Wishing you all the best. Stay safe.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit a question to 2 per participant. If time permits, you may join the queue for any follow-ups. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi, good afternoon. So just on the debt side, just wanted to check, like, what are the kind of covenants you have in place, like from the banks?
Could I just request you to repeat the question?
Sorry, I was asking what are the kind of covenants that you would be having in place for the debt? I mean, in terms of net debt, EBITDA, and those kind of, would there be some covenants in place?
Covenants for it.
Could we take this question one-on-one with you at a later time?
Okay. Sure. And in terms of the synergy benefit, you mentioned that 167 per ton is the synergy that you have kind of unlocked so far. So the reported EBITDA per ton is close to around 530-540. So like if we exclude that, then the number of actual EBITDA excluding synergy comes to like 360-370. So is that the right way to read that?
So we would like to focus on the 2 parts to our EBITDA improvement program. We had mentioned internal levers through which we were looking at a 250 INR per ton improvement by FY23. These internal levers are all specifically driven projects, and we have already realized 167 INR per ton against the target of 150 INR per ton for the current year. Part 2 of the EBITDA improvement is the part we have found challenged in the quarters Q2 and Q3. That is, we had budgeted for a 5% increase YOY on cost front. Cost increases have been above this factor. Further, given the market conditions, in the Q3 we were not able to recover the cost impact from the market. So these are additional levers which we see improvement in some measure with the demand improving in Q4 of this year.
So, no, I appreciate that. I understand it was a tough market in Q3. I was looking to tally the numbers. You mentioned that 167 per ton has been the synergy gain so far. But if you exclude that, then actually from the reported numbers, then the number comes to about 370 odd in terms of excluding synergy EBITDA. So I was just checking, is that the right way to look at it? Or am I missing something on that front?
I think we are making a fundamental mismatch here. 570 is the Q3 EBITDA per ton. So if you are netting off 167, you should be netting it off from the running EBITDA per ton of 895.
Okay. But 167 is the run rate, right? What you mentioned, 167 is the run rate.
Yes, absolutely. 167 is the 9-month cumulative rate.
Okay, fine. Thank you. Yeah, that's all.
Thank you. Next question is from Girish Chaudhary from Spark Capital Advisors. Please go ahead.
Hi. Thanks for the opportunity. Couple of questions. Firstly, on the capex, what we are seeing that in light of this pressure in the East market, pricing and profitability, and with more capacities slated to come in the region, what would be your stance on the greenfield capex? Are you thinking of deferring this? Just wanted to understand the risk management on the balance sheet side. Does it make sense to pause, delever the balance sheet, and then maybe restart the capex? That's my first question.
In FY23, all capexes will be advanced, but for Gulbarga, which will get activated in the Q3, Q4 of FY23.
So what would be the breakup of capex, let's say in FY23 and FY24?
FY23, the capex breakup will be roughly 500 crores for Gulbarga. We will be taking this 400 crores investment in debottlenecking Rishta, Nimbol, and 50 crore in our AFR project. Apart from this, we would be having our regular maintenance capex, which would be of the order of 300 crores. We typically kept about 1,000 crores for maintenance capex over a 4-year period.
So if I add all this, it's around 1,200 odd crores for FY23?
Right.
Yeah, so which is what I was sort of trying to ask. Does it make sense to pause the Gulbarga capex and maybe look at delivering the balance sheet and then maybe start or restart the capex? Hello?
Actually, our original plan for Gulbarga was 3,000 crores. We have now announced phase 1 of the project. So the Gulbarga project is being phased out with an extension outlook as of now probably of 2 more years.
Okay. So when is the time? So what is the timeline for commissioning then for the phase 1?
The timeline for commissioning earlier was FY25. We stay committed to FY25 commissioning, but only of the IOPs of the operation.
Got it. And then what would be the capex breakup? Let's say the capex budgeted in FY24.
FY24, we will just align the numbers, but as of now, if I were to take a view, about 500 crores is what we are seeing in the year. This would be primarily the Gulbarga phase of the investment.
Got it. My second question is as part of your initial remarks, you did mention about some key growth initiatives. You plan to augment volumes by 2.4 million ton. So what is this about? If you can just break up the split of this 2.4 million ton and also the timeline.
So 2.4 million tons is the volume augmentation that we are looking at in north and east. This is primarily going to come from the debottlenecking, improvement in our clinker availability, and also an improvement in our C/K cement clinker ratio with our thrust on PCC. That's composite cement. Roughly, this 2.4 is 1.5 million tons in north and 0.9 million tons in east. The projects are being, some of the projects are already under commissioning. We announced in Q2 that we have started the debottlenecking in Rishta, and we also had a groundbreaking in Q3 of the Nimbol facility. These facilities will come into operation progressively from H2 of FY23, roughly 50% in FY23, 50% in FY24.
Got it. Thank you, and all the very best.
Thank you.
Thank you. Next question is from Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hello.
Yeah, please go ahead.
Yes, Rajesh.
Ma'am, I have a few questions. First is on the realization, which you mentioned that you have seen 30 rupees realization improvement in East and 10 rupees odd in North. So if we look at your January average realization, how would they stack against Q3 average realization like to like?
50.
January realization versus average of Q3?
Probably, yeah. Can you hear me?
Yeah.
Yeah. So if I were to paraphrase your question, you said that we spoke about the 30 to 50 rupees realization improvement in East. This is in our context. We have seen this 30 to 50 rupees realization improvement.
No, I'm asking from company's perspective itself. Your 30 rupees jump, which you have taken in East and 10 rupees in North, how do, on an average for your third quarter, what is the improvement, or is it still below your Q3 average realization, the January average prices which you have realized?
We have seen about a 400 INR per ton realization improvement.
No, this is versus or exit, versus Q3 average or versus Q3 exit?
This is versus Q3 average.
Okay. And coming to the cost item, you mentioned that because linkage coal was disrupted. So two questions. First, how was your per kilocal costing in Q3 and where do they stand now? And second, has the linkage coal supply normalized?
As I mentioned, linkage coal supply has started improving since the second part of December.
Okay.
We had gone down to a 12%. We are inching upwards again towards 27-30%, not fully realized at the end. And with regard to your coal, 1.12 going up to 2.5.
Sorry, this is your blended total cost, 1.12 in third quarter?
Yes.
And this has gone to 1.?
2.5. 2.05, I'm sorry.
Sorry, 2.05 is the current, and for third quarter average is?
Third quarter was 2.05, Rajesh.
Okay, then fourth quarter I missed again.
1.12 Q3 FY21, 2.05 Q3 FY22.
No, I am asking for Q3 and Q4 of this financial year.
Q4 on a total power fuel cost, we do not see a substantial improvement or change. You may assume that the Q3 power fuel cost will hold for the next 2 quarters.
Okay.
While we will continue to work on our internal levers, some of it might go to offset the increasing cost trend.
Okay. Okay, great. And on the synergy, when you mentioned this 167 rupees per ton for the 9-month numbers, which if I do the, multiply with the volume numbers, it comes to around 60 crore savings or 60 crore additional incremental total EBITDA year accumulated in the first 9 months. Is that understanding right?
Yes, it is right. Perfect.
Okay. And so in the fourth quarter, this extra improvement, the current run rate, which could be to the tune of 20 crore per quarter, that would continue?
Yes, we had budgeted 150, Rajesh. The indication as of now is we might inch better than that.
Correct. So because you have already achieved 167, so for this year, at least this 20 crore quarterly run rate should continue in fourth quarter onwards. And additional.
Absolutely. We are optimistic about being able to drive higher CPP and WHR benefits. That is the only line item. CPP is the only line item in which we took a little beating because of the non-availability of linkage coal and of course the higher coal prices.
Okay.
So that should be an additional improvement factor.
Great. And 2 questions on the capex front. First is on the this blending unit where you are converting into a grinding unit. What is the capex for that unit specifically, and how much grinding capacity it will lead into?
So roughly, it will be a 200 crore capex. This is so just to give you the perspective on northern operations, we are working on a clinker debottlenecking. With this clinker debottlenecking, our capability to manufacture cement would go up to 6.5 million tons. At the moment, we are selling roughly 4 million tons in North India. So we are going to make available for sales another 2.5 million tons of cement in North.
Okay, so your North capacity from current level will increase by 2.5 million tons.
Yes.
So
from current capacity, it will increase by 1.5 million tons. But from current sales level, we will make available 2.5 million tons.
Okay.
So this should be a very good volume to meet our aspirations with the launch of the Double Bull brand and our growth objectives for the northern market.
Okay, great. And last question on the leverage net debt to EBITDA. What is the target for March this year?
So December we ended with roughly 5495, roughly 5,500 crores of net debt. We see us holding at this level this 31st of March. We will continue to work, as I mentioned before, on the financing cost piece, which we see going down. Recent refinancing has been something at a 5.7% level, so they should keep bringing an improvement in our financing cost. And as I already shared with you, in the coming 2 years, we will be phasing out some of our capex plan, which we discussed in a fair bit of detail prior to this, while in no way impacting our availability of volume or appetite to grow.
Okay. So where I was coming from, because you are close to 3.5 debt to EBITDA ratio, net debt to EBITDA ratio in December, and this is what your, again, this number would remain stable around 3.5, 3.6. So what is the target on the debt side? Because you also have, ongoing capex which you have to undertake. So any meaningful correction on this leverage front, net debt to EBITDA numbers?
Rajesh, we are staying on track with our plans to be debt-free by early FY25.
Okay, and so there are, in the interim, there are no such, like this number should come down to below 2x in FY23?
We have not taken an outlook for below 2. The guidance for FY23 was of that nature.
Okay. Great, ma'am. I'll come back and queue. Thank you.
Thank you. Our next question is from Shalini Vasanta from DSP Mutual Fund. Please go ahead.
Hi. So on the capex and leveraging front, right now the debt is about 5,500 crore, and with the balance IPO proceeds, we expect it to come down to 4,800. And with the new capex, where do you expect this number to peak in the coming years, 23 and 24?
Shalini, actually we are scaling down on our capex program. The whole idea is to stay with our plan to be debt free. So if you're moving to a medium to long term, I just confirm to Rajesh that we are staying on track with our plans to be debt free by early FY25.
Sure, thank you. That was my only question.
Thank you.
Thank you. Next question is from Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Just a couple of questions. One on the 2.4 million ton capacity growth you outlined. You're increasing clinker, there's clinker debottlenecking of 1,000 ton per day. There is the Bhiwani 0.5 million ton GU. But still you're saying 1.5 million ton increase in capacity in North. That's largely assuming higher blending. What exactly are you thinking of basically launching new products there? And same thing with I think it is implied in the capacity growth for East. Is it you just assuming higher blending, and how do you plan to achieve that higher blending in both the regions?
Yeah, Satyadeep, a very good question. So let me clarify. The first step we are taking is debottlenecking Nimbol operations. This will make available 4 million tons of clinker, and at a running C/K of 1.6, some improvement in non-trade trade, because we have plans to go increase our trade volumes, and that is why we have launched the Double Gold brand. We see a 1.6, 1.7 blended ratio, which is a fair assumption, taking our cement capability to 6.5 million tons. And as I mentioned, current capability is 5 million tons, so that is the gap to 1.5 million tons. Just to clarify, when we are moving cement for blending from an IU to Bhiwani, it is OPC. But when I set up a fresh capacity, I will retain this OPC for PPC blending in the parent plant. So we would be setting up grinding capability of about 1.2 million tons, 0.5 million tons, which we will hold back in the existing IUs, as PPC would give us 0.3 million tons. So that's 1.2 plus 0.3 million tons. Does that explain the numbers in North? Then I'll move to East.
I didn't understand fully. So you're saying the current capacity is 5 million ton in North. The GU will give you another 0.5 million tons. So that takes you to 5.5. And then the blending would mean lower use of clinker. But would you be? You're saying you'll be able to sell more than 5.5 million ton cement in North India?
No, Satyadeep. Let me just clarify. Nimbol is firstly going to be a debottlenecking project, which is going to increase my clinker throughput to 4 million tons.
Right.
So 4 million tons of clinker at current C/K would give cement capability of 6.4 million tons. I currently have 5 million tons capability, and that is where the additional 1.5 million tons is coming.
So that is basically room for additional.
Sorry, the 0.5 you are adding for Bhiwani is OPC transfer currently from IU to Bhiwani.
Okay.
So that capacity, when I convert to PPC, it is grinding capability, which I currently have in my existing unit. But because I'm transferring the OPC upstream to my Bhiwani unit, I am not fully realizing the capability in my IUs in Nimbol and Chittor. So what we can do, Satyadeep, I still feel you have a little doubt on this. We can definitely connect maybe tomorrow or so, and surely I'll clarify this.
Okay. And the second question is on the synergy front. So the company has already realized 167 rupees of synergies. The incremental synergies is largely from the higher utilization of WHRS volumes and maybe incentives. But have you hit the cap on premiumization in terms of increasing Concreto in the overall volume mix or increasing some other products? Where are the incremental synergies going to come from here on?
So firstly, at 32% premiumization in Q3, we are talking about a market condition which was depressed. Our appetite for premiumization in our plan is up to 38%. So there is scope for improvement in premiumization. What we have done from a synergy point of view, we had earlier taken a perspective of manufacturing Concreto cement only in the Jajpur plant, but we saw an opportunity and have made a very successful entry of Concreto in the Panagarh unit in November, in the middle of a difficult quarter and Q3 quarter. So we are going to see a full ramp up of Concreto volumes in the Q4 and quarters to come. So on premiumization, there is still a lot of headroom. Our premiumization program is also very bullish in the northern part of the country, where we are currently operating at a 7 to 8%, and we see capability of driving this to almost a 12 to 15% level. The third area in which we have revised our plans, looking at the positiveness in the market. We had earlier looked at a 1 to 1.5 million tons of PCC, but we have made a successful launch of composite cement from Jajpur, Panagarh, as well as Jojobera plant. In fact, in all these three plants, we have practically taken a 100% PPC to PCC shift. So composite cement is going to be a thrust area in the coming year. The other areas in which we will be delivering further synergy benefits, as you rightly pointed out, WHR and CPP, CPP particularly was depressed in Q3. That is going to be a strong operating lever in the quarters to come. As we ramp up our volumes in Jojobera, Panagarh, we will see better incentive deliverables. We will also we'll continue to work on the procurement synergies. Full benefit of procurement synergies has not accrued given the highly cost inflationary conditions in the market. So this is another area we see improve in the quarters to come.
Okay, just one last quick question, if I may. On the incentive part, you're factoring in higher incentives in Jojobera, and I think part of the decision on Bhiwani is also predicated on incentives. Given what is happening in Panagarh and the entire eastern region on incentives, is incentives only a small portion of your overall decision on maybe Haryana also? And are you fully confident of realizing these synergies both in Haryana and Jharkhand?
Haryana, the primary reason for going to Bhiwani and making it a grinding unit is speed to market. You will appreciate that we already have facilities in that market. We are already selling with a strong brand equity, full volumes from Bhiwani plant. So ramp up in market, go to market will gather a lot of momentum. Additionally, the Haryana government's active policy on incentive was a good incentive in turn for us to fast track this project. But the primary consideration for going in north comes from a successful launch of Double Bull. Our appetite for growth in that market, better pricing conditions. So a strong reason, company capability as well as market-wise.
Thank you so much. Thank you.
Thank you.
Thank you. Next question is from Shravan Shah from Dolat Capital Markets. Please go ahead.
Thanks. Ma'am, first of all, last time we have talked about the 20 million ton volume target for this year. So we have done 12.23. So here also, humble request if you can share the last 7 quarter 2 decimal cement volume numbers to exchanges would be great. It is very difficult to tally the number because last time the 3.8 million ton volume you mentioned in the presentation, and now you are saying this quarter it is 10% decline, but it actually comes at 11.1. So there is a mismatch, and we keep on mentioning the Imami volume from the 1st April, which is not the case. So it's a simple question against the revenue. What's the realized or the sold volume for last 7 quarters? If you can share on the exchanges, it would be great. Or if you can mention the 9-month volume number. So the simple thing is in the 4th quarter, can we, so this is the suggestion, in the 4th quarter, can we see, so 20 million definitely will not be able to achieve. So how much we can see the growth in the 4th quarter on the volume front first? So that's the first question. And also if you can share the RMC volume numbers for 3rd quarter and 9 months, both 22 and 21.
Yeah. I appreciate the suggestion you made. Any clarification that you require or data one-on-one, you can always reach out to us with. Now coming to the question of the outlook for the last quarter. So as I mentioned that we are seeing favorable market conditions in Q4. We last year we did about 5.6 million in the last quarter, and we surely see that we will end at this or a slightly improved figure.
Okay. And in terms of the touching base with your IR is already done for last post the results, but haven't got the proper number. So that's what I wanted to share on the investor forum. Second is just once again coming back to the normal thing, as you mentioned, 400 rupees realization average increase in this quarter. On the cost front, are we expecting any further increase from the 3rd quarter average? Because I can see the change in inventory is also supported in terms of the EBITDA this time. So that number is also significantly higher, 330 rupees. So if that effect will be nullifying in the 4th quarter, we can again pressure on the EBITDA per ton. So just trying to understand on realization you said, but on the cost front and ultimately the EBITDA per ton, how do we see? Because last time what we promised in terms of the power and fuel cost, we said that 150 rupees increase we can see in the 4th quarter, but we have witnessed a significant 400 rupees kind of increase in the power and fuel. So just trying to understand where we are going wrong in terms of the giving the guidance.
Power and fuel cost has gone up for the entire industry. In fact, the positive manner to look at it is we at least have some operative levers, which, as I mentioned, that we will be focusing on for Q4. On power and fuel costs, I did mention that we would at this point of time look at holding these kind of cost levels. Again, to reiterate, action plan being that we see our linkage coal supply going up, as well as being able to operate our CPP, given that linkage coal supplies will continue. So standing where we are, we see both in a favorable light. So unless there's a change in these two conditions, the rest of it, in whatever manner it impacts us as a company, will impact the industry as a whole.
Okay. Other data points just to clarify, in terms of the capacity you tried to explain to the previous participant, but once again I'm just trying to understand the current capacity cement is 23.82 million ton, where it will be by end of FY22, 23, 24. And I'm not asking in terms of our ability to sell the cement volume. I'm just asking that cement capacity.
Yes, we will share this with you.
Other thing just
because
wanted
you're talking about a build-up year on year.
No, because you mentioned the debottlenecking, clinker debottlenecking, 2.4 MTPA, including the Bhiwani, you can sell extra. So I'm trying to understand where our capacity will be by end of this year, next year, FY23 or 24 from current 23.82. That's the first thing. Second, in terms of the capex, you said this year 1250 odd crore. Next year, only you have talked about the 500 crore on the Gulbarga. So when will we start spending on the Gulbarga grinding, or only we will be spending 1500 crore on the clinker? So if you can help me on that.
So as of now, we have made announcement for the Gulbarga IU, which comprises 6,000 TPD, scalable to 10,000 TPD, as an engineering design, with a 1.5 million tons cement capability in the IU.
Thank you. Mr. Shah, request you to join the queue for any follow-up, as we have several participants waiting for their turn. Our next question is from the line of Urmik Chaya from Asian Market Securities. Please go ahead.
Ma'am, can I have the cash flow from operations for the period April-December?
Yeah, just bear with me a minute. So I have here the cash flow from operating activities YTD December 21 that stands at 527 crores.
527 crore rupees. And ma'am, my simple point is that you have raised 1,350 crore through IPO, and your principal repayment plus interest for the current year should be in excess of 2,200 crore rupees. So you think in the Q4 you will be able to generate sufficient cash flow to avoid debt trap?
So 700 crores is set aside from my IPO funds for paying off debts which are going to mature in the month of March. On a net debt position, I gave a guidance that we see ourselves holding it at a current level of roughly 5,500 crores.
No, ma'am, I understand that. What I am saying is, as per your annual report, current maturity of long-term debt in 22 is 1883 crore. The interest outgo would be in the range of 400 crore rupees. So principal plus interest repayment would be in the range of 2,300 crore rupees. Against that, net of IPO proceeds of 1,350 crore and cash flow of first 9 months, you think Q4 cash flow will be sufficient to meet the entire debt repayment requirement from cash flow, or you will need to raise debt to repay debt?
No, we will not have any requirement to raise further debt.
Okay, ma'am. Thanks.
Thank you. Our next question is from Pavas Petia from Enam AMC. Please go ahead.
Hi, ma'am. Just want to understand your working for FY25 leverage being zero. What kind of assumptions you have taken for profitability, and is there a component of working capital release in that?
We will revert to you on this question.
Okay. But still, it's very difficult to understand how you will be debt free considering the 5,400 crores out of debt in next 3 years, whatever the capex you have. Is there a significant profitability increase you are building in? Just on a broader level, can you guide something?
See, you are asking for a perspective on FY25. That is why I said year on year, we will revert to you. We have an outlook of better EBITDA, lower interest costs. I have been emphasizing our actions in that direction, and I just shared with you a phased capex program.
Okay. Okay, thanks. That's all from my side.
Thank you. The next question is from the line of Utkarsh Nopane from Haitong. Please go ahead.
Yeah, hi. Good evening, madam. Madam, I just need one data point. What is our RMC sales volume in December quarter? And are we on track to reach 6 lakh cubic meter RMC sales volume in the current March quarter period?
Ready mix, our revenue from the volume Q3 FY22 was 420 cubic meters. Revenue from the operation was 183 crores.
And madam, are we on track to reach to increase the volume to 6 lakh cubic meter in Q4?
Yes, we are working towards that program. 200 a month.
Okay, thanks a lot.
Thank you. Our next question is from Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, madam. Hello.
Yes, please.
Yes, ma'am. Ma'am, firstly about this interest rates, what is our blended cost of funds currently for the working capital as well as for the long term? And what is our current working capital requirement in absolute terms? If you could give the requirement money in rupee terms.
The total financing cost is 6.68 period ended December 21. I will request my finance team to revert to you on the working capital and fixed cost.
Ma'am, on this 6.68, are these fixed or floating rate? With a rising interest rate scenario going forward, are we at any risk of revision in interest rate, or these are fixed, and what is the tenure then?
Floating rates.
These are all floating rates?
Yes.
Okay. And out of the what is our total WHRS capacity, and what are we planning going forward for say FY23 and 24?
WHRS, I'd like to confirm facilities are up in all plants totaling to 45 megawatts. So it is only new facilities that we will need WHRS. And at this capacity, we are at a 2:1 power to cement capacity ratio.
Correct. And what is our trade and non-trade mix for this quarter and as well as for the 9 months?
Q3, we improved our trade share, ending the quarter at 75%.
Okay. And what are we eyeing, ma'am? So, say 1 year down the line, how is this mix going to change, or is it in this vicinity, in this bracket only?
The outlook on trade share, as we shared, we have an appetite to increase trade share to about 80% of our business, which will not be a one-step activity, will be primarily driven by building the Double Bull brand and improving our trade volumes in North. In East, as you know, we are already a very strong trade player. So it would be a phased program, and at 75%, we are on track with our plans in this regard.
And what is our current market share in the eastern market, where we have the major capacity?
So as you know, by capacity we are the market leader, but this market also sees the material availability into the market from other spaces. Our market share trends around 17%, 17 to 17.2%.
Thank you. Our next question is from the line of Abul Fateh from Baroda MF. Please go ahead.
Good evening. I actually wanted to, this is a follow-up to the earlier question on the net debt.
I'm sorry, you will have to speak a little loudly. I cannot hear you.
Can you hear me? Can you hear me?
Yes, please. Yes, please.
Yeah. So this is a follow-up on an earlier question on the net debt free target by FY25. So I just needed odd assumptions that you would have made on volumes for FY23 and 24 in your numbers, and also the EBITDA per ton that you would have assumed. So these calculations would be based on some volume assumptions and profitability. So because you are already falling behind the target in FY22 versus 20 million tons volume, I think you would end up with 18, and profitability also taken a hit. So all the calculations would have gone haywire at this point in time. So what is the assumptions that you are working with, if you can share that?
So firstly, I would like to bring to the notice of everyone on this call that what we saw in Q3 was we cannot have a quarter in which there is a transporter strike in one state, simultaneously there is a flood issue in two states, and Bihar, which as an industry contributes 22% of the demand, sees a sand mining crisis, bringing demand practically to a grinding halt right up to the middle of December. These are markets typically in the east. Revival happens immediately post the festival period. There has been no release in the market till practically 20th of December. So the Q3 cannot be indicative of where we are going to move ahead in the coming quarter. I am not at this moment additionally mentioning the cost impact. I know, gentlemen, you all have been asking for the plans up to FY25. As an organization, we are in the process of drawing up our AOP. We are in the midst of that exercise currently. I mentioned to you that directionally we will keep to our commitment of being debt-free by FY25. We are working on the financing cost. We are working on improving prices and profitability, leveraging fully the benefit of our internal levers, and finally looking at an improvement in the market condition. You will also need to keep in mind that I have shared with you a phased capex program while not bringing down our growth appetite in the identified up to FY26 period.
Okay, so no,
given, roughly speaking, up to FY26, we had given a capacity of the order of 28 million tons of cement. With the restructuring we are doing, prioritizing on our stronger northern markets, we are still keeping to that number.
Okay, thank you. Thank you so much.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you so much for your patience and very important questions. I'd like to start by confirming, please do reach out to us for any further clarifications, and we'll be more than happy to connect with you. Since our going public, we have been meeting on this call. This is the third call we are taking, and we have also, I believe the feedback has come from most of you. We have also tried to remain available and within easy reach for any further data clarification and post-call conversations. I'd just like to again repeat Q3 Black Swan event, if I were to give it a description. We remain focused on premiumization, improving our trade share, delivering on our internal levers, rupees 167 per ton, ramping up our alternate fuel to 6%, which for plants at a 20%. We are investing in Nimbol and Rista plant and will be exiting year FY in these two plants with also an AFR target of 20%. Net debt declined by 1,235 crores since March 21 and a substantial reduction in our cost of borrowing with refinancing of loans.
Thank you very much.
I take the opportunity again to wish you, your families, a safe and happy 2022. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.